Okay, so let's talk through how a company would calculate its total income tax expense and then look at how we would figure out what the current income tax expense would be and what the deferred portion of that total would be. Okay, so remember we're going to have a total income tax expense on the income statement, and it's going to be split between current and deferred. So what's owed currently and what is going to be or likely to be paid in a future period. So in this example right here, they kind of break out depreciation as a separate expense line item here just to show you example of what's going on when you have different depreciation methods for book and tax. So basically this 460 is just book income. All right, they broke out the depreciation as a separate line here. This is book income 460. For tax return purposes, you have, this example gives us an extra tax deduction for depreciation of 20,000 more. So for tax purposes, you have taxable income of 440 that's going to show up on your tax return. Well, for book purposes, this book income times 35% gives you what would be your total income tax expense. On the tax return, you would have a current income tax expense of 154 because this 440 is what the taxable income is going to be on this year's tax return. So your total expense, tax expense is 161. Your current is 154. The deferred piece is just the amount of tax you expect to pay in the future because you paid less tax this year. So how much less tax did you pay this year because of an item that's going to reverse in the future? The answer is $20,000 times 35%, or $7,000. Because this difference in depreciation amounts is going to flip or reverse in the future. So in the future, book depreciation expense will exceed the tax deduction by that $20,000 and save the company the $7,000, or I'm sorry, cause the company to pay an extra $7,000 in taxes that they reduced their tax liability by this year. And you can kind of see what I was just talking about right here. Here's the current expense. The deferred expense is the $7,000 that the company would expect to pay in the future because they were able to reduce this year's taxes. In the next, in the next year, and kind of a continuing example, we can see in this example how the situation would reverse. You would have less tax depreciation than you're allowed to expense for book purposes. Therefore, you'd end up with more, come on, thing sticks a lot, more income tax liability in 2011 than you have as a total expense, income tax expense. So here you see your current income tax expense, which matches your tax return, but then you recognize that you have a deferred tax benefit in 2011 because you always think of what's the future impact of something happening this year. Because of this year, you take less tax deduction. That means in the future year, you take more tax deduction. Okay, so that would reduce future years' taxes, hence causing a deferred tax benefit. You see, it says expense here, but it's a negative number, so it's a deferred tax benefit. So this 203 minus 7 is the 196 total income tax expense. Remember that total is just derived by taking net income, basically what this is, times the tax rate. And really, in this problem is really eliminating the idea of permanent differences. Really, before you multiply this corporate tax rate, you would have book income or net income after you've considered permanent differences here. That number times the tax rate gives you total expense. It's just that there are no permanent differences in this problem, so they're not addressed. If you look at the journal entries then to report the two examples we just went through, the 2 years we just went through, here is 2010 where you have the total income tax expense of 161. Expenses are always debits. Here's the payable being credited to show your liability for what you owe this year, and here's the liability being created for what you expect to pay in the future. And then here in 2011 we see a reversal of the situation. Here's your income tax expense. There's your payable for what you expect to pay this year, and you're reducing your deferred tax liability because when you thought you were going to owe more in the future back here, and this is you actually are paying more in the current year in 11, so you reduce your deferred liability. You don't have that deferred liability anymore.